Good morning, everybody. Mike Tedeschi, Wealth Management Advisor over at Perspective Wealth Planning with this week's market breakdown video. As always, if you like what you're seeing here, please subscribe to the channel so you can see this information on a weekly basis. This week, we're going to go through the four major U.S. indexes. We'll take a look at the Nasdaq Banking Index, also take a look into the emerging markets, gold, oil, the Dow Jones Transports, and as always, we'll have a couple of really interesting data sets for you guys. So let's jump right into it here. First and foremost, we have a chart of the S&P 500. The key level that we had been watching was that 30-20 zone. You've heard me talk about it a lot. We did close above it yesterday. And on this chart, I put the 200-day moving average on here for you. That's that purple line. We closed above the 200-day moving average for the first time since March. Now, I want to actually take a look at one data set here right off of the bat, and that is... let me zoom in here for you guys so that you can see it. The amount of time that it has taken for us to get back over the 200-day moving average once we have fallen 20% below it, and taking a look at every instance where that's happened in history. What you'll notice here is on average, it takes 214 trading days for us to get back up above. The shortest time frame before what just happened over the last couple of months was back in 1930, and that took 111 days for us to get back up over that 200-day moving average. And right here, this year, it took us 56 days. It's not even close to anything else in history in terms of the speed in which we have come back up. Everybody that's been watching the market action here over the last couple of months, and after seeing that absolute historic drop and watching the market essentially rise with no pullback, and has felt like this is not something normal, this is something that usually doesn't happen, you would be correct. Nothing like this has ever even come close to happening. It's again, the closest time that in terms of days that it took to get back up over the 200-day moving average is almost twice what we just saw. And on average, it's 4 times slower to get back up over the 200-day moving average once you drop 20% or more underneath of it. So this is absolutely historic. We know it's historic just watching the price action, just seeing how it felt over the last couple of months, watching this market shoot back higher. But taking a look at that data set really puts it into perspective. Nothing like this has ever happened in terms of that incredible move back to the upside. Part of this, of course, could absolutely be attributed to the major intervention that we have seen out of central banks. They have pumped trillions of dollars into liquidity. The Fed started buying junk bond ETFs, which they've never done anything like that before. Basically unprecedented action out of the central banks to help support this market. And subsequently, we have seen a lot of that capital flow back into the market, and we've seen an absolutely incredible and historic rise. Now, when we take a look at the indexes here, there are still major resistance points over where we're at, and not everything is made equal here. And you'll really clearly see that when we take a look in at the Nasdaq here in a moment. The next level of resistance really comes in about that 3120 to 3150 zone here on the S&P 500, and that would be the high from the original first bounce after the selling started there at the end of February and the beginning of March. If the S&P can get back up over that zone, really that all-time high is definitely right there in the sights for the S&P 500. When you want to talk about all-time highs being in the sights for an index, the Nasdaq is basically right there. Yesterday, we did have a little bit of a sell-off there. We gapped higher and we sold off for most of the day, and then did rally there at the end of the day into the close, but still closed down the day. What we have here out of the Nasdaq is all about a 1.5% move to get to all-time highs. You can see we got back up over the 200-day moving average on the Nasdaq all the way back in the middle of April. But we never fell that far below the 200-day moving average. We didn't get to that 20% rate that we saw there on the S&P 500 and some of the other indexes. The Nasdaq, we know, has been the most strong by far of all the indexes. It has not been close. And again, we have very little to go to get to that all-time high. So the level that we're watching there, of course, is that 9740 zone there in on the Nasdaq. Now, we take a look at the next couple of indexes, we're going to start to see a bit of a difference in terms of performance. Let's take a look at the Dow Jones. Well, the Dow Jones is still underneath the 200-day moving average. And what we had drawn up on this chart was the resistance zone from the low area from back in August and October of last year, and that's right in here. And that's where we're at right now. We're right into that resistance zone. And we still have a declining 200-day moving average sitting above us, so we have that to worry about. And the S&P 500 is essentially equivalent to being up above this line. So a very different behavior between the Dow and the S&P 500, and a massively different behavior between the Nasdaq and everything else. So we need to continue to watch this. While we have had quite a bounce back up there in the Dow as well, we still have a lot of resistance points overhead that could continue to act as a problem. And more importantly, we're still underneath that 200-day moving average. We come in and take a look at the Russell. It's even more apparent, right? We're still way below that 200-day moving average. We're below the lows from last year. We are still down a ton for this year. We're not near the all-time highs. And in fact, it didn't even make a new all-time high at the beginning of this year like the rest of the indexes did. We know that the Russell has been exceedingly weak. We've talked about it many, many times. The action here over the last couple of days has been very strong. But we still have that 1450 level to contend with, then the 200-day moving average, then we've got the resistance back up here at 1600, then we have that 1700, and then we have the all-time high. So there's a lot that it has to do to get back to that all-time high. It has been good to see the incredible move here in the last 5 or 6 sessions off of this. What looked to be a breakdown ends up being a false breakdown, and we have seen a 22% rise in the last couple of weeks. So that is a good sign, but again, we still have all of those major resistance points sitting above us. When we start taking a look at some individual spaces, the Nasdaq Banking Index is still below the gap from March, still way below the 2018 lows. There is a lot that needs to be done here. Again, incredible bounce here over the last few sessions, but it's just right back up into resistance. Very cleanly sloping downward 200-day moving average. All right, we take a look in at the Dow Jones Transports here. All right, we have had a push back up, but let's put those resistance points for this on the chart as well for you guys. Right, there was the 2018 low. We got back up above that, but here we have that next resistance point, which is going to be about where the 200-day moving average is as we move forward. And we have our next resistance point up here, and then back at those highs. Remember, this is another area of the market that didn't make a new high at the beginning of this year before the selling started. So it's been weak, continues to stay weak. And the transports are a really important portion of the economy, as are the banks. And it's very difficult to have long-term upward performance of all, broad-based performance without the transports, without the banks participating in that. Oil, interestingly enough, has failed right at a very important level. These are the levels that we've had drawn on this chart. We've talked about it a number of times. That gap down zone right at about 35 is the next major key level that oil needs to get back up above. Needs to get up into that 42 zone to close that gap and then above. You can see the 200-day moving average cleanly sloping downward there as well. We had a really nice bounce, but we are right at that resistance point. Okay, this week we had another increase in inventory supply, and we were expected to have a big down draw. That didn't happen, and subsequently oil was down about 7% yesterday off of that news. Right, still hasn't broken below that all-important 30 level, so now we've got a 30 to 35 kind of range that we're watching here. A break above 35 gets that 42. A break underneath 30 really starts getting a bit concerning. Now, again, would show that very weak demand, and that would not be a good thing economically for us. Now, gold. I want to back this up again. I want to take a look at this on a monthly chart, okay? We are still right into that major resistance zone. We popped up into that 1780 zone and failed once again, have pulled back down a little bit. It's still holding over 1700. If you're watching this space, you really want to see gold get up over that 1780 zone. That's where some really good moves to the upside can occur. We'll continue to watch that as well. We take a look at the emerging markets, right? We are right up into that resistance zone. We have talked many times about that resistance zone right in there at about that 940. We pushed up into it here. We have not pushed back up above it. So again, when we're looking at all of these things, we can see some charts that are way below their declining 200-day moving averages, way under resistance points. And then we take a look at the Nasdaq, and it is at basically all-time highs, just 1% away. And we have the S&P 500 finally up over the 200-day moving average. So we have a very split market. The difference between the leaders and the difference between the laggers is huge. All right. That dichotomy probably can't last forever. We should see either these weak names see the money flow into it and see rotation higher, right? We saw an incredible move there out of the Russell over the last few sessions. That is certainly healthy, right? But if we can't get up over these important resistance zones and we start to fall back down, what's more likely? The Nasdaq continuing to go higher forever and ever and ever while the rest of the market goes down? Or maybe those leaders might start to fall a little bit. And one of the reasons why those leaders might start to fall is the way in which option betting out of the retail traders is occurring at this moment. This is the last data set I want to take a look at here today, but small traders are back to spending over 45% of their volume on calls. Historically, when we see that level of optimism out of small traders, it has not worked out well historically. 1 week later, averaged minus 3%. 2 weeks later, averaged minus 5%. A month, 2 months, 3 months, 4 months, 6 months, a year, all of them negative expected value. There is not a greater than 30% win rate out of this set. And a year later, we average about 20% to the downside, 17.5%. All right. We are seeing incredible optimism at areas on the chart that are ripe for failure. This is the concern. This is what we're paying very close attention to. The positive, of course, is that we have seen incredible leadership out of the Nasdaq, but it's concentrated into a small group of stocks. And when we have that concentrated into a small group of stocks, that makes it very hard for the rest of the indexes to stay buoyed. Remember, healthy markets have broad-based buying. We have lots of stocks that are rising, making new highs, etc. And in weaker markets where things might look okay, like we have right now, we're seeing most of the wealth concentrated in the top tier names, which are carrying the indexes because they're so heavily weighted that way. But under the surface, we have lots and lots of issues. I think what happens here next, guys, is very, very important. We're really especially paying attention to what's going on here on the S&P 500. I think that's a much better barometer than some of the other indexes because of how diversified it necessarily is. We're up over that 200-day moving average. Can we hold over that for a week, for a good bit of time? And more importantly, what do we do if we do push another couple of percent higher and come into this major resistance zone, which was that key resistance zone from the beginning of March? A failure here would not be a good thing either. So a lot going on. As always, we're going to continue to stay on top of this for you guys. If you want to reach out, talk anything about the markets, you can reach me at mtedeschi@perspectivewealthplanning.com. You can give me a call at 814-580-9881. I would love to talk to you guys about anything related to the markets. I will see you guys next week. Hope all is well.